Greetings and welcome back. I'd like to take just a few minutes of your time right now to share a few thoughts about how we might take this concept of risk tolerance and apply it much more broadly within the financial planning process. Normally, risk tolerance is discussed in the context of investing and how portfolios should be allocated, how they should be allocated in a way that takes into account clients' risk tolerance. And that certainly is an appropriate application of the concept. But I want to suggest that it can also be really useful information when addressing a whole range of financial planning issues and questions. For example, risk tolerance is extremely relevant when you're talking to a client about how to structure their retirement income. It's very often the case that clients will be retiring from a large organization in which they have the choice of choosing a lump sum distribution from their retirement plan when they retire, or an annuitized approach where they get guaranteed monthly income. And so that involves a trade-off between their legacy goals, if they have any, and income security. If someone, and I'll talk more about that in a moment. Mortgage finance. Clients are always asking us the question, should I pay off my mortgage? Or how much mortgage should I have? Should I have a bigger mortgage? Should I pull cash out of my home equity? And there is a risk tolerance dimension to that. A client who's more risk tolerant might be more tolerant of more leverage, of having a bigger mortgage on their house, or entering retirement with a mortgage on their house, which a lot of people have been taught to think is anathema. Likewise, when acquiring a car, should it be financed? Should it be leased? Should it be purchased? There are trade-offs with each one of those choices that can rightfully be framed most appropriately if we have a full understanding of the client's risk tolerance. Insurance, that's an obvious one. How much insurance should someone have? I always like to point out that insurance companies will sell you enough insurance to soak up your entire budget. You can always buy more insurance than you can afford. And so the question is, how do you strike the right balance between retaining risk and transferring risk to an insurance company? And that is a risk tolerance question among many. And finally, Social Security. Should I take benefits at 62, 65, full retirement age? Should I defer to age 70 and get the biggest benefit? There's a risk tolerance dimension to that as well. So these are just a few examples of situations where we're asking clients to explore trade-offs and make choices where their inherent risk tolerance would be useful information in how we frame that conversation. I like to think of risk tolerance as a fulcrum. If we start with that earlier example of someone choosing guaranteed income versus favoring their legacy goals, you might take someone with a low risk tolerance and say, well, the fulcrum of that particular trade-off is going to be skewed towards income security. They're going to give more weight to income security if they have a low risk tolerance and much less weight to fulfilling legacy goals. On the other hand, someone who has a very high risk tolerance might be much more inclined to take a chance, to accept less income security in pursuit of the potential, at least, for bigger legacy goals or fulfilling legacy goals. So these are questions that where an individual's risk tolerance will cause us to frame the conversation and frame the trade-offs in a different way. Now, we've talked this week a lot about risk profiling and the whole idea that a risk profile has three dimensions to it, not just risk tolerance, not just this, what I believe is considered a fairly stable psychological characteristic, the trade-offs that someone is willing to make, but also their risk capacity. And this is something obviously financial planners have a lot of influence over, because if we help someone establish an appropriate emergency fund and to acquire the right types and amounts of insurance and to ensure that their estate plan is up to date and various other aspects of their financial plan are up to date, we've helped create more resilience in their life. And the more resilient their life is, the more resilient their finances are, the more risk they can afford to take on. And finally, risk perception. Because while this notion of risk tolerance, or while this characteristic that we call risk tolerance may be somewhat stable over time in terms of the trade-offs that people are willing to make, their perception of what the trade-offs available to them look like is going to vary quite wildly, and is a very unstable measure. And that's one of those things that we as financial planners have a responsibility to do, is to keep people anchored to an appropriate perception of the risk. Now, in the case of investment risk, oftentimes it's our job, especially during tumultuous times, like when we have, an economic meltdown, such as we had during the dot-com meltdown, or the real estate bubble and the Great Recession, or the COVID meltdown of last year. This is a situation where often it's our job to try and shift risk perception in the direction of the trade-offs being less risky than clients might otherwise believe or might otherwise be feeling. But sometimes we need to go in the other direction, especially when we get outside the investing context. So, given risk tolerance, what do we do to shift risk perception, and in what direction do we want to shift it? It's going to be driven in part by not just the nature of the decision, but by the client's own risk tolerance that we've presumably measured. So let me give a case study. And this is a real study involving some clients where the husband had inherited a substantial sum of money. And for him, that was financial security. He did not want to go back to work. He wanted this to be his opportunity to I don't want to say retire, because he continued to be actively engaged in a lot of different activities, but at least not to have to earn a living any longer. On the other hand, his wife saw this as an opportunity to completely remake their home, to actually realize a dream that she had long held of creating a truly unique home, the kind of thing that might appear in Architectural Digest. In fact, one of her architects told her, if you build this home, it will end up in Architectural Digest. And then they also had a son who was an entrepreneur. He had started a new business. The business was expanding and had huge cash needs, more than the business could internally support. And so that was also a potential risk, you might say, a potential claim upon their assets. And so the key decision that was before us was, should they build that dream house? So we use Photometrica, and you've all been experiencing that this week. This was the husband's risk score, and as you can see, it was well above average. And this was the wife's risk score. She was obviously pegged way on the risk tolerance side of the scale. Now, when we had our discussion and I helped frame this issue for them in pursuit of making a decision, I will confess I did not go back and look at their risk tolerance scores. And so I might have done something different had I done so, but I didn't. So what happened? So they did, in fact, decide to build the dream house. And when my analysis suggested that they had enough capital to build the dream house and still meet their spending needs based on our safe spending system, based on a reasonable, safe withdrawal rate, but only just barely. And my experience with building dream houses in the past, with a lot of clients over the last 30 years, was that whatever the contractor says, whatever the architect says, you should assume there are going to be cost overruns every time. And I worried about that in this case because of the fact that, again, based on the numbers I was provided, it seemed like it was doable, but only just barely, with no room for error. Naturally, in the end, construction costs went massively over budget. Their son's business needed multiple cash infusions. And so we encouraged them to adopt some policies, some financial planning policies that we hoped would provide some guardrails. I mean, the policies involved agreeing that spending for lifestyle expenses had to stay within their safe spending target, and that every time they had withdrawals for non-lifestyle expenses, every time they had withdrawals that exceeded that safe spending target, we would do a reset. And every time we did a reset, we would reset to a new and lower safe spending target. So what was the result? Well, ultimately, they built the dream home. It was beautiful. It was spectacular. I mean, I toured it multiple times, and it was very impressive. But between supporting their son's entrepreneurial needs and the cash overruns of building this admittedly spectacular home, they ended up with too little capital to actually maintain a reasonable lifestyle based on our safe spending system. And so ultimately, as they feared and as they admitted they would prepare to do, they lived in the home for a couple of years and then they sold it. And they moved to a new location where they were able to build a replacement home for a much, much lower cost, restoring the balance to their finances. So what might have been different? Well, if I had started out by reminding myself that the husband had an above average risk tolerance and the wife had an extremely high risk tolerance, that she was extremely risk tolerant, then I might have framed the conversation differently. I might have framed the trade-offs differently, because what did I need to do? I needed to shift their risk perception. Now, unlike, as I said earlier, many times when we're dealing with clients and their investment decisions and their portfolio, we're working to shift their risk perception in the direction of the trade-offs being less risky. Because very often they, especially during turbulent times, their perception of what the trade-offs look like shifts in a much riskier direction. This was a case where I needed to shift their perception of the risk in the riskier direction. I needed to be louder. I needed to dial up the risk. I needed to dial up my description of the magnitude of the risk, the consequences of the risk going against them. I needed to frame the conversation in a way that shifted their risk perception in a riskier direction. Not because it would automatically have resulted in them making a different decision, but because I believe it would have allowed them to make a better decision. I needed to dial up the volume in order to penetrate their high risk tolerance. And in order to do that, I needed to shift their perception of what those trade-offs were, of the magnitude of those trade-offs, given this extraordinarily high risk tolerance. So how can this guide the conversations we have? If we refer to the risk tolerance score for each client before every financial planning conversation, at least every conversation on an important topic where they have to make a decision and the decision has consequences, this is going to allow us to think about how to modify their risk perception, or how to frame the risk perception and frame the trade-offs in a way that's appropriate to their risk tolerance. How to penetrate their risk tolerance, either by bolstering their confidence when their risk tolerance is really low, or by attempting to dent their perception or dent their risk tolerance when the risks are really high and we're afraid they're not seeing them. And the other thing that a reference to risk tolerance will tell you is who may be the driver in the process and why. Sometimes if you're dealing with a couple, sometimes one of them will be the driver because his or her risk tolerance is really low, and they're very fearful of the consequences of a decision they're about to make. Sometimes the driver will be the member of the couple who has a very high risk tolerance, and they're driving to make the risky decision, if you will, because their perception of the risks is very low, because their tolerance is so high. So these are ways in which we can think about using the risk tolerance information across the entire range of financial planning decisions and financial planning conversations we have. So don't allow what you learn about a client's risk tolerance to be constrained to only conversations about investments and portfolio allocations. Think about it as a useful input to every conversation you have with them about every financial planning decision, especially when it's those big decisions where the consequences are large. Anyway, I've been enjoying our conversation so far this week, and all I can say is carry on, post early and post often.